are determinant for interest rate in a given economy, and that's why you will find a positive correlation or same kind of trend when we talk about bond yields and interest rate. And any other question do you have, Paritosh? This is good question, and I was assuming that when after our discussion, you will be able to relate why this is so, and why we say that bond yields are important determinant and why we need it in any economy. Yeah. Any other question? Okay, so we will start our today's session. I assume right now around 21 students are available. So this is what, if you remember, we have discussed. So this is the real interest rate, and we have seen, if we leave this part more or less across time period 2004 up to December 2010, more or less you will find negative real interest rate. It means the inflation was more, and that caused real interest rate negative. And we are going to discuss in detail in subsequent slide. But this is a kind of trigger for you, that if you are thinking that I can invest in government securities, or I can invest in 1 year government security instrument, or shorter term money market instrument. So what kind of return these instruments gave during 2004 and 2010 after making adjustment for inflation. So this is what trigger for you whenever we are going to discuss about real interest rate. This will give you more clarity that that this kind of trend we have just observed during 2004 and 10. And this is government, U.S. government security, 10-year bond. So again, more or less, if we compare with Indian scenario, so more or less you will find similar trend. Here you will find difference. Reason is very clear, because in India we have gone for a special program GSAP in April 2021. So this is what one thing government has done. But in US also, if you are referring various textbook or various resources, US is also considering similar approach. We call it quantitative easing. So this is quantitative easing. So this is also similar kind of non-conventional monetary policy that in US it is being in practice, and whereas in India RBI has just started GSAP, purchasing government security on behalf of Government of India. And always we are interested to see what is going on in China. In China and US, if you see, almost same trend is slightly different, because in China we generally, because of the way they strategically go for their trading activity, in most of the time you will find Chinese indicator or indicator based on China, they are leading. Leading means they are ahead of in most of the economies. So here you can see that during probably somewhere this period 2020 and 21, there were interest rate were around 3%. Rather than going to percent, just look at the trend, because in US rates are very different, whereas in China rates are very different. But if you look at the trend in China, you will find trend is ahead than US. The way you know, trends are emerging, these are showing a kind of lead trend for US, and that is happening because of macro scenario which are different in US and in China. And this is another trigger. This is two type of securities. So one security is this, we call it T-bill. T-bill is basically, you can call short-term government security. Whereas, so this is basically 3-month maturity. 3 month means 90 days. You can see here it is mentioned, and long-term means 10-year. So you can easily see how these two are different. So this is blue one is representing your short term. This is your short term, and this is your long term. Because short term yield tells would be what is the market scenario in short run. And when we talk about 10-year security government bond yield, that are a proxy. That is, basically a proxy for long term and medium to long run, no long term. So this up to large extent tells you what kind of economy you will be having by looking at these trends. And here, you can see at least few cases. This is the 2007-8 crisis. So what we are observing that short-term trend down and long-term trend also down, but the gap between short-term and long-term, so this gap is a very good indicator. We are going to talk about that indicator. This indicator tells the ambiguity in investor when they consider medium and long-term investment versus short-term investment. So what we believe that the ideal scenario would be the gap between these two should be same. Means the gap should not vary. If it is, let's say more or less 1.5% between short term and 3 months versus 10-year, it should be consistent. But whenever you will find the gap between these two is more, it means there is clear ambiguity among the investor. Whenever they want to take a call whether I should go and invest in long term security versus short term security, so that ambiguity arises. So that's why these are very good proxy for understanding the economy, understanding the market scenario. And that's why we must know, because at the end our our effort here is to understand the financial system as a whole, and that system cannot we cannot understand unless we properly capture the macro scenario. This is Japanese case, very interesting. Hardly you will find this kind of trend. So here you can see this is basically interest rate. So this is bank interest rate. So what we are observing is negative. And now you need to think about what would be the scenario when these rates are negative. How people will be, or how theorists, people who are working in this domain, what kind of interpretation we can have. So this I'm leaving to you, and then once we complete it, I'll ask this question to to you to interpret what do you we mean by negative interest rate and how it is going to influence given economy. So keep this, that it is not always the case that interest rate is going to be always positive. It can be negative, and we have several such examples. So we will be coming back and seeing similar examples. Now There are various theories. So far, whatever we have seen, we try to relate. We have seen yield, basically yield of 10-year government bond, 10-year bond, and then we have also seen some trend related to interest rate. And Paritosh has also asked question why we have some kind of relationship between these two. So that question we will be now discussing in detail. First we will discuss about the interest rate, why and what factor basically decide the movement of interest rate, and then we will relate interest rate with the yield. So more or less, we know that any asset, whether it's physical asset or it is financial asset, all assets are more or less driven by demand and supply schedule or demand and supply conditions. So there is a theory, we call it theory of loanable fund. So what this theory suggests? This theory suggests that interest rate in any market will be function of how much demand and supply is there for available fund. So what does it mean? Like even demand is more for loan. So basic theory, if we follow, if demand for anything goes up, assuming that supply is constant, what will happen to interest rate? Can anybody tell? If demand for interest goes up, considering the fund available is constant, what would be the impact on interest rate?
It should increase.
It should
Exactly. So
increase.
basically, it's very basic. More or less, these theory you would have studied in your previous courses, or in general, when we talk about demand and supply, this is how relationship exists. So whenever demand goes up for fund, and assuming that available fund is limited or it is constant, of course, interest rate will go up. And similarly, when we talk about supply side, if supply increases, assuming no change in demand, what will happen? Interest rate will go down, because when there is more supply than required demand, of course you will find a mismatch, disequilibrium, and in that case, in that scenario, you will find decline in interest rate. And same, this loanable fund theory suggests the same, that interest rate, which is basically a equilibrium point here. So if here you have, so this interest rate here, some R star, this interest rate would be function of quantity or loanable fund available and your supply and demand scenario in economy. So it means there is so this theory is in isolation. In isolation, why? Because there are many things apart from demand and supply that impacts. But in broader sense, this theory gives a framework to understand why interest rate should move, assuming that supply of fund is known in the market. Now, why interest rate change? So one thing we have, this theory suggests that why how interest rate is related with supply and demand, but why it keep changing. So we will take both side, demand side and supply side of schedule. So here, scenario one, if we relate, there is increase in supply. This is our previous schedule. Remember, this is DD and SS was the initial scenario. Scenario made in sense that this is the initial diagram. You can assume that this is initial diagram, but what happens? The supply people start saving because of certain reason. They start saving. It means supply of fund increases. So earlier supply was this. Now because of increase in supply, this schedule will shift, and this schedule will will be new one. This is supply schedule will be SS prime. So because demand has not changed, but the supply has gone up. So what impact we will see that this interest rate which was R prime, R bar, it will be R double bar. So effectively there is a decline in interest rate by this factor. So this is the change in interest rate. Why? Because there is excess supply or there is additional supply of fund. Now similar scenario you can think of when demand will increase. And these are very practical scenario. Of course, we are looking from in an isolation condition, but slowly you can keep adding and you can keep relaxing those external constraints. Now coming back to demand theory. So what we are assuming that this is our initial these two are our initial supply and demand relationship, and this was our interest rate R. And now if demand for fund has gone up, so this will become your new demand curve. If that is happening, what will happen? Demand is more, supply is constant. So in that case you will find that interest rate will go up. Here you can see from R to R bar has gone up. So here if we take the difference, so this is the delta, this will be the change in interest rate observed in economy. So now in this scenario we have seen supply and demand separately, but you can think of various such scenario where both are dynamic, both are changing. Economy is expanding, but and people are more interested to participate, so they started saving. So your demand and supply schedule or demand and supply curve both will shift accordingly, and then you will have new interest rate. So this is what basic theory suggests why interest rate is not going to be a constant number over the period of time. Reason is very clear, because there is different factor that drive demand, and there are different factors. We will see all those factors, those who that drive your supply side, and both are different. And that's why based on the equilibrium between supply and demand, interest rate is going to be decided. Is it clear? Because this is very easy theory. You can also relate with the physical asset class, how demand and supply impact the price of physical asset. Right, so we are moving forward now. We have understood this theory. So what are the determinant or factor that impact the supply and demand schedule or supply and demand function? So here you can see we have seen that interest rate, how interest rate, we have seen interest rate is directly related with the supply. So this is what relationship we have seen, and in case of demand we have seen that there is a, because we are talking about loanable theory, loanable fund theory, so there is direct influence of supply and demand. Now coming back to the point, total wealth. So if wealth is increasing, it means your fund is increasing. In that case, your supply will increase, and then there will be inverse relationship with interest rate. Remember, this scenario here. When supply increase, your supply curve shifted from SS to SS prime. In that case, your interest rate gone down and it gone from R to R prime. So this is what we are, referring. So there is an inverse relationship. Now, second point is risk of financial security. If risk of financial security is increasing or decreasing, there will be a direct impact. Near-term spending need. Remember, if because how your fund will increase if you don't see any requirement of fund, or another or simple way, if I put, let's say every month you are earning 2 lakhs, and if you assume, or if you think that there is no need for me to keep excess money with me, so what you will do, you will go, assuming that you prefer bank, you will go and put your money in your deposit account. Why? Because you are not observing, or you don't think that you need to consume that money at all in near future, and that's why you are keeping for long term future. So it means your near term spending is going to decide your saving, basically your or the quantity of fund available with the institution or with the banks, and that's why there is a direct relationship. Now, coming back to macro factor, monetary expansion. Whenever, like quantitative easing or GSAP, if you go and read GSAP, or when we talk about QE, quantitative easing. So in these two scenario, what happens? Securities are purchased by the central bank. Like in US, Federal Reserve has purchased security from the market, government securities and various other maturity securities. And when securities are purchased, money is infused in economy. So it means when more supply is there, the way we have seen here, if supply is more, there is less requirement, interest will go down. So this is another relationship we see. And another condition is economic condition. And remember, economic condition, the best way to gauge economic condition, you look at the GDP figure, you look at the 10-year government security yield. So these are basically proxy for economic condition. And if economic condition you see is healthy, there will be enough capital, or supply would be more, and in that case what you will observe a negative relationship. So this is what one side of curve, like supply side of fund, we have seen. Now coming back to demand side, why and what factor determine the change in the demand side. So demand side means utility of derived from the asset purchase with the borrower fund. Of course, there will be a direct relationship. So here it will be direct, like the way we have seen in this case. Of course, economic condition. If economic condition is good, companies or various individual or institution, they would prefer to go for more borrowing, so there will be a direct relationship. But whenever a restriction on non-price conditions are put, like you can think of a tax rate, increasing tax rate, or some kind of macro event, or various restriction from the government side, it hinders, or it stops the demand side, and that's why it's negative relationship we observe, means interest rate will go down. So these are certain reasons why why we have change in supply and demand schedule. So already you can think of already we know what are the factors. So there are certain determinants of interest rate, change in interest rate, and reason is very clear. We will also see in when we talk about Fisher's theorem. First part is inflation, because remember whenever we talk about nominal interest rate, it is function of basically two things. It is function of your inflation, and it is function of your real interest rate. It means your nominal interest, whatever we observe in the market, like nobody or any institution never never tells about real interest rate, because real interest rate is something which is going to be decided based on inflation. But the thing that whether it's bank, when bank says that you will be charged 11% of interest rate, so that 11% or 12% is basically nominal interest rate. It already includes your inflation factor. So that's why you will never find any institution, anyone quoting the real interest rate. All quoted interest rate in any respect are nominal interest rate. Please remember. So a continuous increase in price, if there is continuous increase in price, definitely it will have impact on the interest rate. Yesterday we have discussed about how inflation rate is going to decide your interest rate, and we will be again numerically we will also see how inflation and interest rates are related. Real interest rate, nominal interest rate that would exist on security if no inflation were expected. Means real interest rate, your real interest rate will be equal to nominal interest rate given that your inflation is 0. So this is the condition. And other what factor determine the real interest, your nominal interest rate is default risk. What is the default risk? Default risk is the risk that is observed when issuer of particular security default their interest and principal payment. So what we are referring, let's say there is a corporation, and corporation has issued let's say debenture or debt instrument, you can talk debenture, and as per debenture company was liable to pay certain interest plus principal amount. If company is not able to pay their interest and principal amount, we call it that company is defaulting their obligation, because interest and principal amount is the obligation because company has issued debt instrument or bond or debenture based on institution we can call. So the risk investor perceive because of probability of default that can happen in case of this corporation, we call it default risk. We will also see how we can capture, but by definition we will first see. And remember, if default risk is high, whether interest rate will be high or low, can anybody tell? If default risk is high, interest rate will go up or go down?
So interest rate should go up.
Exactly, because interest rate is a kind of opportunity cost. So if you are investing in a company, and if a company's asset or company's reputation is not very good, rating basically reputation, rating is not good, you will expect more return. More return means you are by theory or by assumption you are assuming that you are investing in high risky asset, you must be compensated. So that risk is basically a default risk. Similarly, liquidity risk, there is a probability that asset you purchased, you may not be able to sell it at low cost. Because why you are purchasing asset? Because you want a kind of return. At the same time, you want a kind of substitute for your cash equivalent. So even if you have purchased a particular bond and if you are not able to sell it quickly in the market, it means there is less liquidity available in the market, and the risk that you will have because of less liquidity in the market for your asset class, we call it liquidity risk, because you are not able to sell it and to get your cash back or your price equivalent price. It means there is a risk associated with that asset, we call it liquidity risk. Then special provision, when we talk about provision, taxability, convertibility, these are, callability, these are other terms. Like, whether your instrument is having some provision related to tax obligation for company as well as for investor, and whether you can convert into bond into equity, or whether it is callable options or not. So these are basically special provision or conditions that are associated with bond or with fixed income security. And also term to maturity, as we will see in subsequent slides, that whenever we compare to investment, let's say investment for 2 years versus investment for 10 years. So whenever, let's say, same company is issuing 2 bonds. So company is same, one bond is 2-year bond and another bond is 10-year. So in which case you think that company should offer you more return, in 2-year bond and 10-year bond? Can anybody answer?
So in 10-year bond.
Why you said, why you said so?
So because company is taking longer to pay, so the default risk in that time would be higher.
Exactly. So, yes, because the period for which your money is going to be blocked or will be with the company is longer in 10 years. So by normal assumption, because there are various assumptions we will talk about later, considering in normal market scenario, you will expect more return from your investment. And that's why interest rate for long maturity investment should be high. Remember, I'm saying should be high because we have very opposite scenario, like Japanese case we have just seen for for our reference, and there are several such examples where this theory may not be applicable or may be distinct from what we are assuming in this slide. So now we should quickly, more or less, you all know how we measure inflation. Basically, we can measure inflation through various measure in like CPI, Consumer Price Index, and this tells the how much costly a basket of certain goods and services are in economy, right? So so that's why we use inflation as a proxy to gauge the prices of goods. So here I have put some trend, Indian trend from Ministry of Finance, what kind of what you call inflation was there in India. So you can refer to that. And CPI, by name Consumer Price Index, it measures the average price of basket of consumer goods and services available in economy. So this is how you all know. That's why I'm assuming that we know. So change in CPI means there is change in the value of the basket. If value of basket has gone up, then your inflation rate, here you see, if let's say earlier value of same basket was 100 and now value of same basket gone up to 150, and if we divide by 100, so and if you multiply it by 100, so you can get that change in your inflation rate. So this is how generally it is calculated. And this is a proxy, and we have seen how inflation and interest rates are related, and that's why we should know how to calculate inflation. And real interest rate is interest rate that would exist on security if no inflation were expected over the holding period. So to relate real interest rate and nominal interest rate with inflation, Fisher has given one theorem. We call it Fisher effect. So what is Fisher effect? Fisher effect basically relates real interest rate, inflation, and nominal interest rate. So what assumption was made when Fisher has given this explanation? First is reduced purchasing power on fund lend due to the inflationary price change. It is very clear, like whenever price of particular basket or price of goods goes up, then you will find reduction in the purchasing power, and that's what is one thing Fisher has observed. And second, additional premium above the expected rate of inflation for foregoing present consumption. It means if you are expecting high inflation rate right now, then it will have impact on your expected inflation rate. And that's how that we are going to see in this relationship. So how he has explained this is what nominal interest rate we are talking about. Nominal interest rate is function of real interest rate, expected inflation, IP, and plus real interest rate into expected inflation. And what is observed, when he tried to convert this function into a similar equivalent function, he observed that generally this part is very small, and that's why ultimately what he observed, that the relationship between nominal interest rate, I is nominal interest rate, this is IR is real interest rate, and expected inflation rate is directly related. We can calculate it. And the real interest rate basically difference between nominal and inflation. And that's why if you remember when we talk about here how inflation and interest rates are related, these are related when we think of this relationship, Fisher effect relationship, that suggests that inflation, your nominal interest rate is nothing but summation of your real interest rate and expected inflation, and that inflation is going to be changed because your CPI, your value of basket of certain goods and services are going to change. It may go up, it may go down, and based on that your nominal interest rate will change. So this is how we have this relationship. This part is clear. This is very easy, and some of you may be aware of this Fisher's theory related to your nominal interest rate, real and inflation. Now, this is something that will tell you what is the current scenario. In previous slide, I have also shown you the scenario of Indian investment, and this is from US. So you can see over the period of time how real interest rate and nominal interest rate. So you can see nominal interest rate and how estimated real interest rate has gone up. So this is basically based on what we just read, Fisher's effect. Fisher's effect talks about relationship between nominal real interest rate and inflation, and the gap between these two is nothing but inflation. So this is how we can relate. Now there is one question to better understand real interest rate and Fisher effect. The 1-year SBI deposit rate in 2020 is around 5.58%, and inflation for year was 6%. Assuming that these rates will be unchanged in this year, whether deposit in bank adds value to depositors' wealth or not. So what would be your answer?
So as the interest rate is negative, real interest rate is negative, it wouldn't add value to the deposit.
Exactly. So this is very simple, problem. The reason so that we will be able to relate that if you have this kind of option available, even this is happening. If you go and relate real interest rate with prevailing nominal interest rate that banks are offering, and then what inflation is there in market, you will observe, no value addition in your saving accounts, and that's why you will find more or less over few years the fund available with the bank may drop, and that's why banks are trying to explore other option, because unless bank get the margin means some additional fee or interest between lending and borrowing, because lending and borrowing activity may decline over the period of time. So if that is the case, then bank needs to come with other alternative. Otherwise, bank cannot function. So more or less, so here what we see is negative interest rate, and sometimes if you don't know, we also use BP or basis point. So what is basis point? 1% is equal to 100 basis points. So many times you will observe, this kind of relationship. So you can say that there will be a reduction of 20 basis point in terms of return, and that's why it is not going to add any value to the wealth of investor. So investor may not want to consider this as an option. Now, we have also talked about default risk, if you remember. So basically, what is default risk? Default risk is the risk that security issuer will default and making its promise, interest, and principal payment. How we can measure? It means there should be, we can only measure when we have some proxy or some way that can be used as benchmark, right? Because you have two entities. Let's say if I make it more easier, you have private corporation, and let's say here you have government. If we assume that government won't default, again there are historical example where government defaulted their principal and interest payment on issued bond. But assuming that the probability of government default is very less, it means we can take this as a proxy of benchmark. And that's why when we calculate default risk premium for particular company J is nothing but interest that company is offering on issued instrument for same maturity, and interest which is being offered by government on same maturity instrument. So what basically I am saying, let's say this company has issued let's say a 10-year debt instrument, 10-year debt instrument, and offering, let's say, 7% coupon rate, and other conditions are same. So maturity is of 10 year. And same way, government has also issued 10-year bond and offering 5% coupon and issued for 10 years. So here, when we want to calculate the default risk premium, so default risk premium would be 7 minus 5. Basically, the company is offering. So how we can interpret, company is offering you or investor 2% additional return for the risk investor is taking by investing money in that company, right? It means because government is, the probability of default by the government is very minimal, or can be assumed close to zero. If that is the case, the 2% is the default risk premium company is offering to investor, not to invest in government security, but invest in that company. And that's what we define as default or credit risk. So this is this difference between security, similar maturity private entity or company security versus similar maturity government security. That difference we call it default risk premium. So this is basically, we call it default risk premium, additional return that company is offering for having some probability of default. And you can see if company is less creditworthy, or in terms of investment rating is very low, you will expect, or investor will expect, high default risk premium. So here, whatever 2% we are observing, company may be offering this around 9%. If 9%, then this will go up by another 2%, so this will become 9, and you will be enjoying, or investor will be getting additional 4% for investing in high risky company, or taking bond or debt instrument of companies. So this is, this is what we are seeing. You can see we have a state bond, US government long-term bond, and various corporations, what we call issued same maturity bond. So here you can see, let's say I'll go here. So if you look at here, this is basically this part, or here any reference point, this blue and red one. Red one means this one. So what we are observing that the annual yield for this is lower than this, and blue one is generally government. So here again, there is some variation. So if you look at, make it this reference, so here government, so here is state government, and then this is US. So what we are observing that this is how yield or interest or coupon payment for various securities are increasing. And this tells, you see, when we in rating agency, I also have slide on rating agency rating pattern. So AAA means very stable investment. Company's background is very good, company is very stable, and the investment company has taken in short run and in future are good. So that's why if company is stable, the default risk premium would be low or probability of default would be low. So there is no reason that company will offer you more return, right? And that is the reason. And same logic, can be put here. If because BAA is speculative companies where probability of default is more than AAA companies. And that's why these companies will have to offer more return on their investment. Otherwise, it would be difficult for them to get investors. And that's why the rating agency or rating of company is also important whenever company is going to issue debt instrument or any kind of instrument for raising external capital, right? So we will, if you have any question, I'll take it, and we will stop our, yeah, I think there are some questions. Yeah, is there any question so far? I'll stop our discussion up to this point, and then if you have any question, I'll take it, and next session we will continue from here. Yes, student, do you have any? Yeah, Anuj.
Sir, for a long time, since 1940 to 2000 or 2005, so we see that state corporate, state and local government bonds are safer than US government bonds.
Yes, yeah, yeah. See, understand that in US, it's not like in India. In India, the upper hand is of central government, but in US, basically, US is a country which is basically part of various states, right? And in US, the state regulations are different from central government regulations. If you go and visit, even if you move from one state to another state, you will find, all regulations are different. And that's why that could be the reason why, what in India, what we expect that generally central government bonds are more secure than state government bonds. But in US, because states itself are independent entity, when they can go and raise capital, and if state is let's say creating more, contributing more in GDP, probably that state is more stronger than overall US government bond or US government security. And that is the reason why whatever you have just correctly said, that in this reason, here you can see that the interest offered by the central government, state government or local government, municipal corporation, is lower than what US government treasury bond offered. Yes, your point is very valid, and that the difference is how various states are functioning, are performing at economic front.
Sir, one more thing.
Yeah.
Sir, we know that US Fed can never default because it can just print money because all the bonds are denominated in US dollar only. So shouldn't it be safer than any entity? That was my doubt.
No, that is, we cannot go with this argument. Like, even I have also paper on quantitative easing. So even quantitative easing, if you assume it is started to 2008 onwards, after the Lehman Brothers crisis. The day Lehman Brothers crisis happened, 700 million was infused by Fed. So that is not the case. Ultimately, what is more important is the trust. It may be RBI, it may be Federal Reserve, or it may be Bank of Japan. The main is the trust. Unless you have good trust in your economy, you cannot do anything. Your federal body may be very strong, but that does not give you guarantee that everything will go and will be well controlled in your economy. So I have different opinion when I see Federal Reserve. Many times they made mistakes in taking the appropriate decision. But of course, the most of the trades happening across the world through USD, and that is the reason why US dollar is strong. But we cannot put other arguments with the strong US currency. Yeah. Any other? Yeah. If you read more, then you will realize that many times, decision that RBI has taken were relatively better than Federal Reserve, because we have very different scenario. US is pure capitalistic economy. In India, we are somewhere socialist and somewhere in capitalist. So we are in transition somewhere. So that's why we cannot exactly compare Federal Reserve's action with RBI. But when we see impact on economy, you will be able to relate how good Central Reserve, central banks policy would in Indian scenario and in US scenario. So that's why it's not very black and white answer I can give you, but you will have to look at how various changes in the policy resulted in adding value in given economy. Yeah. Any other question? Okay, I believe I assume that you have understood what we have covered, and you keep reading because this is very interesting. And whether you agree with me or not, I can only cover very small tip of iceberg. This is very big topic and very big course. That's why you keep reading. You should be triggered to read more about these events. Then only your understanding will be better, and whatever course you'll be taking in your future, that will add value. So with that assumption, I am offering this course that it will explore, it will broaden your base, and then in which direction you want to further explore, that will totally depend on you. So with this, I'm closing today's session. If you have any question, you can write me back or you can message on MS Team. I'll try to answer to your questions. Yeah. Thank you. So we will meet next week, and you keep ready with your questions. So that we will be add to more value in our discussion. Yeah. Thank you.
Thank you, sir.
Thank you, sir.
Thank you,
Thank you,
sir.
sir.
Thank you, sir.